Howdy, Team 42. It's your skipper here, Darius Dale, to present our Around the Horn Weekly for Saturday, October 2nd, 2021. As always, we have a ton of content to get through, so let's just hop right into it, starting with slide 3, our key takeaways. Inflation remains the dominant market regime as per its 36% market regime probability. That's the modal outcome. As previously discussed throughout the summer and fall, neither policy nor positioning dynamics suggest the current inflation regime will prove anything other than transitory. It is worth noting, however, that inflation has temporarily captured the modal outcome title in and around the 3 OPEX cycles since the start of Q3. No, we do not believe this time will be different in terms of its duration and ultimate impact on asset markets. That said, our globally interconnected asset market ecosystem remains in a highly unsettled state as per the current fifth percentile overall conviction score. That's among the lowest readings since mid-March, right ahead of the late March crescendo higher in both nominal and real interest rates. FYI, that crescendo perpetuated a very viable dip in risk assets, and we view the current setup in a similar light as per the favorable policy positioning dynamics we've discussed throughout the last few months. And obviously, we outlined our expectations therein in a deep dive last Saturday. So check that out to the extent you have not. All told, we are content to maintain our legacy grid zero portfolio construction. The balance of our systematic inter and intra market analysis suggests the current spike in realized volatility is likely to be of the episodic and non-trending variety rather than its persistent counterpart. Looking at slide 4 here, getting into our portfolio construction, no changes week over week. We continue to think balance is the name of the game with respect to kind of getting through this part of the cycle. This is not, this is, kind of jumping ahead to slide 6 here, skipping ahead. It was very obvious reflation in Q4 of 19. You had your head buried in the sand trying to short tech stocks then, or you didn't. It was very obvious deflation in February to March of last year. You were obviously long the dollar bonds and short pretty much everything else. Then it was very obvious Goldilocks coming out on the other side of that. And then obviously that gave way to, I would argue, probably the most obvious, deepest, most lucrative reflation trade in history of financial markets from November through, let's call it, June of this year. All those trades are extremely obvious in terms of, not only in the delta between the other grid regimes from a market regime probability standpoint, but in terms of also the market regime signals that were being built into that. We don't have that situation now. If you look at the chart on the left, the overall conviction score, the light blue line, that's only in the 5th percentile. That's just the sum of all the total confirming signals. And the reality is we continue to be in this very unsettled, highly neutral state, as denoted by all the neutral VAMS readings that we show on the table on slide 5. So kind of skipping ahead on slide 7, looking at our CACRI, our cross asset correction risk indicator, just kind of making it a little easier for people to interpret that. Hey, when the purple line is in the green box, you probably want to think about buying stuff. When the purple line's in the red box, you probably want to be thinking about booking gains, right? I can't make it more simple than that. So I apologize if I'm still losing people with this. But the reality is you tend to see CACRI get into that consensus complacency box, ahead of meaningful big drawdowns in stocks and big drawdowns in, equity credit kind of beta. And the reality is we just have not been there. The market has been too worried about everything else to get us into there in terms of building up conviction on the long side of Goldilocks or on the long side of reflation. We just haven't done that. And to me, I think that probably means that you're the people who tend to crash the market, CTAs, the quants, the macro funds, the people who are putting on, dialing up and dialing down their leverage with respect to their exposure to risk assets. These people probably aren't in the kiddie pool. We suspect they will be if we're right on this mini reflation trade thesis that we continue to see developing. But for now, it suggests that a more material 10 plus kind of percent correction is something that we would expect to start a few months from now, as opposed to at the current juncture. So let's not confuse back to back OPEX catalysts, which have historically perpetuated realized volatility and the S&P 500 type exposures, and let's not conflate that with, oh my God, the sky is falling, the cycle is about to end, because that's not our expectation, at least from an economic perspective. Grid zero implies that there's not a whole heck of a lot going on economically anyway, although we do think the growth data are set up to bounce in October and November particularly. On slide 8, looking at positioning, bullish medium-term positioning set up for U.S. equity beta. So we saw 120,000 a month-over-month delta. It obviously means there was a lot of short covering because, again, the month-on-month delta is actually bigger, wider than the net length of 81,000 thereabouts. So historically speaking, when we've seen a month-on-month delta in the SPY that big, it's historically perpetuated, one positive 1 month price momentum of 3.1% to be exact. But again, we don't want to be too exact. We don't want to be frequentists. We want to knock on the door of the frequentist gods and have them bless us with 2 thumbs up, but we then want to get back to the real world. The real world is Bayesian. The real world is about updating, probabilities and recording and measuring and mapping data as it comes in real time, to obviously stress test your legacy positioning. That's what we do every day at 42 Macro, and grateful that you guys appreciate that. On slide 9, looking at the crowding and dispersion analyses. And so the one thing that, kind of has me nervous, and again, I'm very clear about this. I do believe, even though we were comfortable buying the dip on Thursday, this wasn't like go full hand, diamond bore hand, 2-handed dip buying on Thursday, because we understand that, look, the setup into, we have another OPEX catalyst in 2 weeks, and this one's going to be right ahead of a potential, debt default. Again, I don't think they're going to default, but again, you could see some political and headline risk associate or develop into that catalyst. And as we've seen all throughout the summer, that these OPEX catalysts, they tend to bring on realized volatility, either through, dealers adjusting their gamma exposure. But what I really think is happening is, the Wall Street gets its bear machine out and gets people to overpay for put protection, which is a very lucrative business. And I certainly have friends in that industry as well. So the reality is that kind of the key takeaway is that the median eyeball premium of 17% means the market's still quite vulnerable to realized volatility spike beyond here and into and through that potential catalyst. So keep your eyes on your fries with respect to that. We haven't seen eyeball premiums on a median basis broadly kind of get back up to that 30 to 50 to 60% range that we've typically seen on the other side of these OPEX catalysts that made it a very obvious buyable dip. We're just not seeing that. So maybe people are kind of wising up and saying, hey, I know another one's coming. I'm not going to, allow the dealer to fleece me again and pay for 31 VIX put protection when I can just wait for the whole thing to kind of calm down. Maybe that's what's happening. Maybe it's not what's happening. That's my interpretation of what's happening. Tweet at me. Let me know if I'm wrong on that. Particularly if you're actually someone who understands options, not someone who reads about it on Twitter. Slide 9, dispersion. Cyclicals continue to outperform defensive some month-on-month Sharpe ratio basis. As we talk about this analysis, we look at month-on-month Sharpe ratios as a proxy for sort of the faster moving institutional flows with the with the thought process that higher Sharpe ratios are likely indicative of persistent inflows, and low negative Sharpe ratios are likely indicative of persistent outflows. And what we've seen throughout the summer was persistent inflows into defensive sectors and style factors from a leadership perspective, and persistent outflows into cyclicals. Now that just flipped on its head a couple weeks ago, and we continue to see evidence of that. So to me, it's that suggestive that the market is not ready to go down, because that's not what you see in terms of heading into a big market event. On slide 11, getting into the wood chopping, and as I mentioned last week, the color coding in the name of the at the top of the page, it's indicative with the VAMS reading. So I'm not going to type bullish VAMS. You can see it on the chart. 2, the color coding should help. But anyway, just getting into the probable range setups. S&P 500 and WTI are both not actionable with respect to their probable range. S&P is close to the bottom end of this probable range, but we'd like to see it touching, or very close to touching, or at the bare minimum, or we'd love to see it on the exhausted below the probable range, because that's obviously a great time to expect a pretty meaningful bounce. That's kind of where Bitcoin and Ethereum were heading into last week. On slide 12, US dollar overbought, but it's flirting with a bullish VAMS breakout. So that's something to keep your eyes on your fries there. It's not the kind of like scary whippy breakout that's like, oh my God, currency vol is going straight up, commodity prices going straight down. This is more of a grind higher that's, in my opinion, being perpetuated by people's expectations for U.S. growth, people's expectations for policy. But it could be worse. It could actually, I could be wrong on that, and this is something that we're certainly monitoring. But there's some other clues later in this presentation that suggest that this is not the scary dollar breakout kind of chart. And as I wrote on, I want to say Thursday in the leadoff morning note, one thing that is positive, one economic scenario that is positive for both the dollar and risk assets is a 0 sigma inflation delta Goldilocks regime. Now it's a mouthful. That just means when the economy is in Goldilocks and inflation is decelerating by a very modest amount, 0 sigma delta on inflation. And so that's historically the dollar's at a 6% annualized return in those months, those 20 months in the 25-year back test where that's occurred. The 65% positive ratio. That's to me, that's like, you could be seeing that, because again, we're talking about the data bouncing and inflation being flat to down in the next few months. And so to me, that's exactly the setup that we have economically. Maybe the dollar's responding to that, or maybe I'm just reading way too into that. Again, that's 20 months of data across 25 years. So we want to be too dismissive of the back test, because it is real. It's looking at the 10-year break even. So Overbought really haven't done anything in this bond yield move, which is shown on slide 13. the 10-year nominal yield has broken out the bullish VAMS. We don't think it's going back to where it was in the beginning of the year when it got up to 1.7, 1.8%. We think 1.4 to 1.6 is a reasonable range with respect to our forward outlook for growth and inflation, which look nothing like the forward outlook for growth and inflation. We're telling you to short the crap out of bonds at the end of last year. The high yield OAS overbought, still neutral VAMS. Doesn't look like the world's about to end either. On slide 14, I tell you what, these ratio charts are definitely telling you the world's not about the end. You look at the high beta, low beta ratio, that's overbought, but it looks like it wants to flirt with the bullish VAMS breakout. It will break out the bullish VAMS if we see any more of the price action we've seen in the last couple of weeks. Small cap, mega cap ratio, that's overbought, but flirting with the bullish VAMS breakout as well. Look at value to growth on slide 15. So I was on this program last week saying, look, value to growth doesn't really want us to do anything. It's the most economically sensitive of all the ratios. It probably needs a real meaningful move in growth higher to get, kind of get it off its butt, for lack of a better word. And then, a week later, it's like, oh, hey, no, look, hey guys, I brought some Mike's Hard Lemonade to the party. Let's go. This guy's looks like he wants to hang out and have a good time. As do we all. So to me, again, I don't think that's a signal that the apocalypse is here or imminent. If anything, I think it's a signal that institutional investors are using the weakness in the overall market in and around these OPEX catalysts and the debt ceiling and all that jazz, and they're using it to rotate into cyclical exposure because they realize that, hey, look, the policy setting for the Federal Reserve and the Treasury is actually not quite going to be as negative as we thought it is. Certainly, I thought it could potentially be going back a couple of weeks ago, 2 to 3 weeks ago. But the reality is we're probably not going to get 3.5 trillion. Look, they're going to attach the debt ceiling, suspend or rate. They're going to have to raise it if they do it with reconciliation, and they're going to attach it to the budget resolution. And guess what? Sinema and Manchin aren't going to let that budget resolution be 3.5 trillion, which means the size of the bully when he returns back to the public debt market in terms of Treasury issuance and public marketable securities, that's not going to be nearly as scary as we thought it was going to be. And in the context of a Federal Reserve tapering program, that's, I don't know, 10, 15 billion a month, or it'll be 15 billion a month they're trying to get done by the middle of next year. But again, going from 120 billion of QE to 105 billion of QE in November, and we're still talking $100+ billion of QE in the context of a Treasury Department that's not overly stressing financial markets. Again, we got 1.3+ trillion dollars in overnight repo that can absorb a lot of the incremental bill issuance we're going to see on the other side of debt ceiling, and in terms of the sort of marketable note and bond issuance that we might see. Again, we're going to see a decent amount of QE supporting that as well. So net liquidity, I say that to say this, net liquidity could potentially be quite favorable, at least in the fourth quarter. It was favorable in the fourth quarter of 2019 when the stock market was up 8.9 or 8.5%, 9% on a total return basis. And that I see a similar setup in the context of, this bounce we could see in high frequency data in the context of positioning not being overly stretched heading into that. If anything, I would argue it's, quite nervous. On slide 16, micro caps making higher lows. Again, this is micro caps, folks. Liquidity dries up at the margins. That's when the liquidity is getting sucked out of the system. Micro caps are going down first. Triple C credit's going down first. Triple C, this is high yield credit spreads for triple C. So it's making higher lows. Like we've clearly inflected from the perspective of the cycle. Like we're no longer accelerating in growth, we're decelerating in growth. But again, they're making lower highs. Like it's not making higher highs, it's making lower highs. Microcaps are making higher lows. These are things that are not signs of the apocalypse. These are things that are telling you that the coast could potentially be clear once we get to the other side of the 10-15 OPEX and 10-18 debt ceiling drama. Again, I don't think the Democrats are incentivized. They're in control of the White House, they're in control of the House of Representatives, they're in control of the Senate. If we have a fiscal collapse and a default and all that stuff, guess what party may never take office again in the United States of America? They'll figure it out. Their livelihoods, the survivability of this party is on the line. You can't default on the debt and cause a financial crisis and economic collapse via tightening financial conditions if you're in control of all three, major branches of government, or not major branches, but if your party's in control of those three pillars of government. So that's my view on that. I could be very wrong. I could be wrong on 100% of the things I say. Could be wrong on 0% of the things I'd say. I'm trying to keep as close to zero as possible, which is why we work so hard here at 42 Macro for you. On slide 17, getting into the wood, defensives oversold, Ethereum not actionable, 18, Ethereum not actionable, the USA equal weight nearly oversold. Slide at 19, Eurozone kind of broke the bearish hands, but I do believe that's going to be a head fake, so we're content hodl that exposure. We see European growth dynamics continue to be more favorable than U.S. growth dynamics and rate of change terms. Bitcoin not actionable. Nice move on Friday for both Bitcoin and Ethereum on slide 20. Not actionable with GBTC. Mega cap growth oversold. Slide 21, NASDAQ 100 oversold, S&P 500 equal weight, RSP, that's not actionable. Slide 22. Again, when I say not actionable, it could be close to the lower boundaries probable range, but again, I want to see something that's touching or below. That's a great opportunity to really, kind of gross up that exposure for those of you who are using this process to manage risk more tactically. S&P 500 on slide 22 nearly oversold. Nat gas not actionable. Slide 23, uranium oversold, giving you opportunity to accumulate exposure. If one of the things, and I talked about this on the Market Huddle podcast this week, check that out if you didn't get a chance to review that. One of the things I talked about is a downside risk to this medium inflation trade. It's like, look, inflation is the downside risk. I think that the left tail of Chinese demand has been sort of cut by the PBOC's guidance on overnight on Thursday in terms of saying, hey, look, we're not going to let the property market collapse. We realize how important this is to a lot of families in China and really the stability and the Chinese political, kind of specter. So that kind of removed a lot of the left tail risk associated with Evergrande, not necessarily a financial tail risk, but more like economic tail risk. And so the reality is now you have China out there saying, go buy crude oil at any price. Like, again, inflation is the bear case. Like, we know that. We've talked about this with the S&P real earnings yield chart that I've put in the past few macro scouting reports. Let me see if I'm good at my job, I can remember the chart number. It's probably slide 72 or 73 in the macro scouting report. 71 to 73. Check me on that. Fact check me on that. Anyway, that's neither here nor there. But again, that's the risk. Like, inflation accelerates from here in a material way that threatens the net liquidity dynamics that have been so favorable for the market, that we expect to continue to be favorable for the market for at least the next couple of months. Beyond this sort of pocket of weakness here. I think that's it. Crude oil going from 75 to 90 is going to have, an issue. If it goes from 90 to 100, we will be, in some sort of real nasty kind of market environment. So again, it's about the pace, about the ultimate level. But again, I think between 75 and 90, you could see a mini inflation trade. But beyond 90 to 100, you're talking about kind of getting to a place where you're going to have social instability, you're going to have policy instability, and things of that nature that are going to be quite unfavorable. On slide 24. Looking at the broader market, VTI not actionable. Barclays Ag is oversold. Extended duration treasuries on slide 25 oversold again. But we're talking about bonds here. I still believe that the 10-year as a proxy could get up to 160. So again, you're talking about another 10 basis points from here from upside. So that's where you really, if you're again managing risk tactically using this process, that's when you really want to be diamond hands buying bonds, in my opinion, because I just don't see the growth and inflation dynamics on a forward-looking basis to get you back to where we got in the Q1 of last year or Q1 of this year. You just don't have the outlook for growth and inflation in terms of the size of the deltas, the triangle hole. You don't have that. And so you have to be acknowledging that in terms of like, okay, how much are you willing to sell down bonds in your overall portfolio construction? Looking at high yield credit, that's still bullish, oversold. J&K, that must have a little bit more duration risk than HYG. So it's neutral, but it's oversold as well. TIP, same thing. On slide 27, TLT oversold, dollars overbought. Could break out the bullish VAMS. I mean, nobody wanted to buy the dollar, and we got long the dollar in June. We bought the dollar, I want to say, in our June macro scouting reports or early June. And I had everybody and their mother going, man, like, you sure you want to buy the dollar? You sure you want to buy it? I said, look, man, I think it's going to be one of the few things that goes up if we get into a liquidity problem at the end of the year. And every single day, we've had multiple previews of this, right? Stocks down, bonds down, commodities down, everything down except for the dollar. We've had like 4 or 5 of those days this year, and it's been a great trade. I had a lot of institutional investors on the other side of that trade when we put it on. And obviously, I'm getting some victory laps on that now. But again, what we're trying to do here is not talk about victory laps. I'm not here to point out wins. I'm not here to point out losses. I'm here to effing help you manage risk ex ante. It's not about legacy this, legacy that. I nailed this or I got nailed on that. That's not what we're trying to do here. If I spend 1 minute helping you do that, that's 1 minute I don't spend on helping you manage forward-looking risk. I'm one person sitting in a room, and I have to manage my time appropriately. And number one thing I want to do is help you make money and not lose it. So with that, thank you so much for joining us. Catch you back here next week. Cheers.